Hello and welcome. This video is going to be one on Fibonacci retracement from a market perspective. This seems to be a very popular topic within the comment section, so I want to go over this little bit newer. I did a video years ago about the Fibonacci retracement, how the numbers are calculated, the 38.2, the 61.8%, and all those kinds of things. This is the discoverer of the Fibonacci code, Leonardo, and I don't want to pronounce the rest of his name. And then this is a very common Fibonacci sign. I'm not going to get into that either. So then, when I do a search for Fibonacci retracement, what I read is, in technical analysis, Fibonacci retracement is created by taking two extreme points, usually a major peak and trough low, on a stock chart and dividing the vertical distance by the key Fibonacci ratios of 23.6, 38.2, 50%, 61.8%, and 100%, written February 3rd, 2016. Let me correct this now. I find the key Fibonacci ratio points to be, well, let's remove 50%, but that's 76.4. Why? Well, why are you going to add 23.6 without its polar opposite number? That's a question I ask. That's an answer I have not received. Okay. But each of these numbers, 23.6, 76.4, they work on the polar opposite of each other. 76.4 is a polar opposite of 23.6, as is 38.2 and 61.8%. Now, as far as what they state up top, it's by taking the vertical distance, which is correct. But what they're doing is they're taking the vertical distance in a linear fashion and not a logarithmic fashion. And markets move exponentially. They don't move in a linear fashion. It's not like a 300-point up day is the same in the Dow Jones today as it was in 1937 when the Dow was even under that number. Okay, so other questions. What does Fibonacci retracement mean? Well, it means that it's a method of technical analysis, really, and I'm going to go through different points. What is a Fibonacci line? It's a line. It's a line to where it is. What is Fibonacci retracement resistance? Well, it's an area you expect to stop to go higher. And what is the meaning of retracement? I'm going to call this profit, at least as far as from a trading perspective. So how they calculate it, how almost every single site, almost every single charting platform, I have only once in my life ever seen somebody else not use this and use this when figuring out Fibonacci. Therefore, they go high subtract low, multiply the fib percentage plus the low. Where with myself, I take high divided by low. That gives me volatility. That gives me the length of the move. So if I'm looking at a stock chart, a very short-term day trading level, I might get a high and low of like 71 and 70. Not much of a difference. But I could be looking at more longer-term views, cryptocurrencies, that could have a difference where the high could be 30,000 and the low can be 4,000. And now you got a larger difference. So then I take that difference and I take it to the exponent of the Fibonacci percentage. And on the calculator, you will see X, Y. So you push that and then you put the percentage in. So 0.236, 0.382, 618, and 764. So let's take a look at a chart. And when you're bringing one up, what you can see sometimes is, oh man, it did nothing, went up a bit, and now this thing is just really, really, really going. Well, these charts should be viewed in a logarithmic fashion, and if I adjust the scaling to such, ooh, we have a difference now. For we can see the movements have changed, and the markets, of course, are in an uptrend. Now, if I were to be looking to buy this now, would it be smart to buy at this point? And the answer is no. It is overextended. And well, how are we going to calculate Fibonacci? Well, we need to go from key points. And I can only really think of two. One are the obvious lows and highs. I mean, this was an obvious high. This is an obvious low, obvious high. They're the easy ones. And then you also got ones for where breakouts and breakdowns can come from. So you have one like here, it starts a breakout. This one starts a breakout. You can count this one as a start, even though it's higher than here. You can go in here, the breakout low for this point there. Those are the levels that you need to look for and try to estimate which one is the best one, which is going to give you the more stronger results. Now, as far as all of the levels, I look at the 38.2% and 61.8% levels. These are the key ones, the main ones, and they determine bull and bear markets, as well give the best buy and sell opportunities. Where the 23.6 and the 76.4, there's a little typo in here. These ones are important marks for determining when markets are ready for big breakouts and breakdowns. They also are decent buy and sell triggers. The 161.8% up and down levels. This is helpful to determine where a breakout or a sell-off should stop. This is also good for timing where to place buy and sell signals. 50% for me is pure neutrality, and for the most part, I don't like buying and selling in neutral markets. Okay, now let's take a look at a silver chart. We're taking a look at a monthly. So we have this obvious low and we have this obvious high. And the Fibonacci marks come in at 25.3 or 25.30 and 16.65. Another way to calculate Fibonacci without a calculator or on a Paint or a Photoshop kind of software is take 38.2% of the difference from here to here, and that line is here, and the 38.2% is here from here. So if you know what the pixel number is here, the pixel number is here, well, 38.2% of it, the difference would get it for you. That's another way of calculating. And then when you've seen it as much as myself, I could pretty much look at almost any chart and practically know where the key levels are because I've seen so many of them and I look for them so often. But in this situation here, this is what you could consider a Fibonacci fail. As far as buying and selling is concerned, it describes the market, so it doesn't fail that way. But this low was a large pierce above. That doesn't do good for buying. It does not do good for buying there. And it doesn't, because you're waiting to buy and your buy orders don't get filled. And then in a situation here, if you were to look at a chart and it misses the key level and then it comes back down, you don't buy there. Not anymore. It's pretty much a test. It's a breakdown level. It's just not a good spot to buy. Well, quite frankly, within all of this, sometimes you got to wonder, is there better Fibonacci? And in this case, yes. Trading using multiple time frames is very, very important because what happened before 2004? Well, what happened was it broke out in 2001 from about $4. So then, let's adjust that Fibonacci. And now we have it from the $3.97 low. when you have situations where you have a major gain and going from 4 up to over 20, back down to 8 and up to 50, well, that's pretty major. So very rarely would I look to be buying at any 23.6% level, but I will here. But wait a second, it says 76.4. The math says 76.4% on the way up is 27.42. That means 23.6% on the way down. Well, that worked out to 27.42. How do you lose if you buy here and the market rallies like it did? Same thing here. Comes down and then it has a little bit of gains. I mean, it's not a big move. It didn't continue any type of upward movements. And then this comes down to a 50% retracement, a level which for me, as I stated earlier, is in a neutral setting. Now, as far as finding levels to buy, I mean, it's a big gap when you consider the movement from here to here, here to here, and here to here, that there's nothing wrong with using this as, say, what would be another kind of buy level. And we can also see if it continues to go lower, then this would be an area of probable support. If you did buy here, you could have very easily put sell targets here. And if you're holding and you have sell targets here, there is not only nothing wrong with that, but I think that strategically works out to be a very good play. Now, as far as Fibonacci upside is concerned, I like to use this mainly for new highs, not so much for what the numbers have already given me already. Any inside numbers, the 38.2, the 61.8. But in this case here, if you never knew the pre-millennium or the 1970s ever existed, you would think you were breaking out to new all-time highs. Of course, that wasn't the case. And if I were to take Fibonacci upside, all I would know for a move would be a couple of them. The big one would be from point A here to point B. That's 21 down to about 8.5. Now, if you were to calculate Fibonacci upside from that point, it wouldn't have worked out the greatest. For you would get 37 in here. So you wouldn't have got this top, nor would you have gotten this one. However, because 1980 did exist and $50 was a previous high, then it really wasn't in play. This is something you want to play for with new highs, new lows, and that sort of setting. Now, I use a software program myself just to make this really easy. So if I were to say, look at the silver move that went from 846 to 2135, again, 37.83, didn't really work too well. However, it kind of did as well. For if you sold at 37.83, well, you didn't get the top, but you certainly bought back cheaper, if that was one of the things that you would be looking for. And again, I'm using the same calculation that I've used before, but I use the exponent of 1.618. Now, how about something for the opposite, for the downside? How would I calculate that? Well, it's a polar opposite of Fibonacci towards the upside. So I'm going to take the high over the low from its down point. So the market has had a downtrend of some sort. It bottoms and then goes up. So I'm going to take the same ratio, high divided by the low, for the length of the move, put it to the exponent of 1.618. But instead of multiplying it by the low, I need to multiply it by the inverse of the high. Now what's going to happen when you do this calculation, you're going to get some sort of small low ball number, maybe something like this with most charts. And then when you inverse it, you take 1 from that number, so basically is 1 divided by all of this works out to Fibonacci downside. So for myself, I never do any of those calculations. Rather, I already have at any time for myself on a program that I've made for myself that can do it. In a spreadsheet, you can do the same sort of deal. It's just for me, I can load this up pretty fast. It's off my screen. I can push one button and it's back on my screen. That easy. So that's what I use, and then it works really, really well. But say, for example, in this case here, if this is like all-time lows and I think this has got one wave lower and I'm looking to maybe find a spot to buy, then that's exactly what I'm going to do. I'm going to calculate this formula, see what the number comes up, and it's going to be decently below this low. And again, I can pretty much eyeball it and find the area because I've seen it enough, but it does pretty well as far as its profitability concerned on the long-term time frame. So when it all comes down to this, this would be, say, a low, this is a high. Anything from here to here, that's the 23.6. This is extremely bearish. Anything in here, this is total bearishness down here, bullishness above here, and neutrality in the middle. Let me just put the percentage numbers for you. So again, 23%, 0.6% on the way up will always be here, as will 38.2, 61.8. And when you get markets that look something like this, it's just very common, and you wouldn't calculate this until maybe here, because you've already figured out point A to point B. So you would see, okay, maybe 23.6% down would find some support, and it's very common for markets to have moves like this, and then you test it more often. The more likely you test it, more likely it is you take it out, and then you go, like, oftentimes it hits support and then you resist it, and then with a bullish trend, you would need, okay, you figure out these lower highs, you got to get above this point, and when it all comes down to it, not all the time will this mark work out as support. Sometimes it'll work as a level where it's like resistance, as you can see in this case. And sometimes it'll just, if a level that's not supposed to be hit isn't, watch out, because let's say, for example, here, let's say it didn't support there. You could buy there and 9 times out of 10 or some high percentage, you're going to be fine. But that means on that low percentage, it could just go boom and have a straight move down to the next one. That can easily occur as well, as I've seen within markets when key levels don't do what I say they're supposed to or what they usually do. That's the usual kind of result. But I hope this helps in the analysis of how I use Fibonacci retracement. The reason why I did this in the first place is I've always liked the logarithmic charts. So when I use the automatic setup, they would look so terrible. But because at the time I was actually using this exponential math on a very similar but different thing, a different idea platform, it was very simple for me to understand and calculate from its moment. So it worked out that when I was trying to understand Fibonacci, I was doing something else that was very related to it. And thank you for tuning in, and I hope this helps. Take care.